Hello and welcome. We are looking at Globe Life today, ticker GL. Over the next few minutes, I'll discuss my thoughts about the valuation of this company and its business quality. We have a market cap of $10.2 billion, enterprise value of $11.7 billion, so you see about $1.5 billion of leverage on this business, operating in the insurance industry. So Globe Life provides, obviously, life insurance and supplemental health insurance products and annuities to middle income households in the United States. So that's an important piece here, that they're only operating, it seems, in the United States. They have 4 segments: life insurance, supplemental health insurance, annuities, and investments. So it has whole life, term life, other life insurance products, Medicare supplement. So Medicare, basically, they have critical illness and accident plans, single premium, flexible premium, deferred annuities. Formerly known as Torchmark Corporation, changed its name to Globe Life 2019. It is interesting. If I were to buy this company, I'd want to understand, what's with the name change. Did they have some sort of problems in the past that they're trying to disassociate themselves with, or is this just a marketing change? I'd want to study that a little bit more. Beta of 0.81, so you had about 18% less than the average S&P 500 company. Any lower beta like that is always a sign that maybe this is relatively high quality, because it's going to be a little bit less volatile. Return on equity. The first thing that I love with this chart is that it's 20 straight years of profitability. But the second thing, and the more important thing, is look at how stable it is from year to year. 13.7%, 14%, 14.4%, 15%, 15.5%, 16.3%. Very, very stable year to year. Strong history of above 10% return on equity. Very, very attractive. Now, the last 3 years have dropped a little bit. So you have 9%, 8%, and 10.9%. Of course, being a life insurance company going into COVID, it makes sense that their returns would be a little bit lower when you have a period of excess deaths. So, of course, that seems totally reasonable to me. It also seems reasonable to me why they would start to bounce back in 2022. Really like what I see here. One important thing for those longtime viewers of the show, this is return on equity because it's an insurance company. A lot of these are return on invested capital. That is one difference here. You see that they have 18% underwriting margins, 20% pre-tax income margins over the course of the last decade. Those are really good margins that I like to see. Return on assets 2.7%, return on investment 2.1%. Of course, they're getting that leverage because you do have float in these insurance companies. You're getting a 12% respectable return on equity. Now, because I like to have to compare insurance companies to non-insurance companies, it's quite difficult. For non-insurance companies, I'm targeting return on equity of 15%. That would still be ideal. You don't really see that here. A lot of times with financial companies, you have a lot of competition here. Insurance companies face a lot of competition, especially on price, but they are above 10%. That's a good sign. They're hitting a 12% mark, so that's also a good sign for me. But that is slightly lower than I'd like to see normally. PE of 13.8, though, is a pretty reasonable attractiveness for evaluation. I like to buy stocks with PE of 15 or less because that helps eliminate the concerns of multiple contraction over my holding period. However, growth rates are pretty low. You have revenue growth 4%, premium growth 4%, asset growth 3%. Basically, you're growing at 4% here. Now, you're getting some operating leverage, so you're getting EPS growth of 7.6%. Whether that's coming from operating leverage or buybacks, we're going to have to dive a little bit deeper. But you're only growing in this 4% range. However, you basically have an entry yield of 7 to 8%, growing at 4%. You have a return on equity of 12%. So you put those numbers together, you can still pretty easily see double-digit returns here. That starting yield, 7% plus 4, gets you to 11%. Holding with a return on equity of 12% gets you 12%. EPS growth, 7.6%. Plus you add in some dividends. You can start to see an attractive return here still, targeting that double-digit range, which I would like to see. Let's look at revenue and earned premiums here. So again, you have this gap here. Earned premium is probably the most important number. You've gone from 2.7 billion to 4.3 billion here. So you can see that growth rate over time. Underwriting profit is important as well. They've basically tripled their underwriting profit over the course of the last decade, but there was a big jump in 2020. I'd want to kind of understand what's going on there. That would need a little bit of an explanation for me. But you can see that earnings have doubled over the course of the last decade. They had a nice big windfall of 2017. And basically they're earning in this $7 range. So, of course, that $7 range, 106, again, entry yield, 7%-ish. Pretty reasonable. Dividend is pretty low, but that's not uncommon for an insurance company as well. So you're below 1% on your payouts. If you're learning something, if you find this video interesting, please hit that like button. We're going to dive into the income statement now. So, of course, revenue is made up of both investment income and net premiums earned. Now, it looks like they've had really, really low investment income over the last 3 years. I do wonder a bit about that, what's going on there, although they've now split out fees, and their fees are significantly high. So maybe this is just a redefinition of how they're defining it, because it looks like this number is matching a lot of these fees and other income, and now maybe this is under other income. That's not a big concern. Again, really on the insured side itself, you really have that underwriting side, which is the premiums earned with underwriting profits, and then you have the investment side. Any insurance company, you're going to get both. I mean, you think about Berkshire Hathaway, what you know about a lot is, of course, the investment side, all these companies that they're buying, but of course, they still have those operating insurance businesses, and you get your return from the combination of those two. The downside with a lot of insurance companies, besides like a Berkshire Hathaway or a Markel, is just that their investments, they invest a lot in bonds. Bonds have yielded really no numbers recently, and that can really impact their overall investment income. SG&A costs have been maintained pretty well. So your SG&A, is up about 50%. Net premiums up about 50%. So, you're in a pretty reasonable range there. Policy benefits claim also growing at a similar rate, so you're not seeing a lot of operating leverage on that line item. But we do see where that boost to EPS came from on the income statement. So again, 4% to 7.5%. How do you get there? It's pretty clear it came from share buybacks. So you see the buybacks happening here. They've retired about 40% of their shares outstanding over the course of the last decade. That's really, really attractive. It's giving you a prig 3 to 4% boost in your EPS each year. I really like that capital allocation. And when we go to the balance sheet, let's see these securities. So your securities went up to $21.9 billion in 2020, but they've gotten a lot lower, down to $17 billion in 2022. Maybe this is valuation. Of course, the bond market has gotten absolutely slammed over the last 12 to 18 months with rising interest rates. So this is not an uncommon thing for me to see here, where they would start to see a massive drop in their securities portfolio. Future policy benefits, I believe this is where you'd see their float. So you see this $17 billion. Their growing float there is really important. That's what they're going to be able to earn their investments on. You see here the security investments, so it's a good sign there as well. Retained earnings, they're funding the company with retained earnings. You don't have a lot of debt, $500 million in debt, $1.6 billion in debt. Again, not a ton of debt here. It's really not a lot of leverage on this business. No concerns from that side. Let's see, cash flow statement. So one of the things I really like is this steadiness of the share buybacks. You're putting out $300 to $400 million per year on share buybacks. It's steady, it's reliable, it's predictable. That's important for you as a shareholder to be able to say, hey, I'm going to get my return from this company because I know I'm getting steady, reliable buybacks. I'm also getting a pretty steady dividend. It's a low dividend. It's not growing very fast, but I'm getting most of my return from these buybacks. I like how that's set up there as well. I wouldn't really worry a lot about this investment line. It's an insurance company. It has to make investments. That's pretty standard, long lead times. They need to make those investments to offset against their claims in the future. And one thing you do not see here is stock-based compensation. Normally, the stock-based compensation would be in this up section. You don't have that here, and so that's also a really good sign. There's nothing stopping these buybacks from continuing to destroy the share count, and you can just see the slow and steady destruction of shares over time. Very attractive from the capital allocation standpoint. So, Globe Life, what do I think? I think this is a really interesting company. I like what they're doing here with the return on equity. You're getting this good, nice double-digit return on equity. Looks like a high-quality business here. Very predictable. You're having a very attractive PE ratio. There's a clear path here to double-digit returns. I love that they're spending all that money on buybacks, giving you a boost from your 4% growth up to about a 7 to 8% EPS growth, because you're getting a 3 to 4% boost per year from the level of buybacks you're doing. So that's a very attractive number to see as well. All that said, lots of good things to like here, but it's not going to be on my personal watch list because it's simply not growing fast enough. I would really love it if it grew a little bit faster. Once you start getting close to that double-digit growth rate, I can really start to see the teen type returns that I want to see, 12, 15 plus percent. And I don't think I can get that here, even though I think I can hit the double-digit range. I think that requires a lot to go right, and I'd really love it to have a little bit more optionality on the business. Overall, though, it looks like a really good business, very attractive price, strong and steady growth, just a little bit more would have gotten it there for me today. If you learned something from this video, hit that like button. Don't forget to subscribe and check out the videos in the watch list above. Those are my watch list companies, my favorite ones in the S&P 500 so far that, again, if this one had been a little bit better, it would have been in that list. So check out the ones that are in that list. If you want to check out this software, quickfs.net, my affiliate link is the first link in the description below. Thanks for listening, and until next time, stop paying fees, start building wealth.